so it's always tricky, and if you looked at the bond market, from a theoretical perspective, government bonds would be your bonds with the least amount of risk. Then you can obviously loan money to corporates, and there's obviously a higher risk attached to a corporate. And a simple way to just think about that is the government has the sovereign right to print money in order to give you your principal back or your investment back. And hence, that forms the basis of all investments. That is the risk-free return, because that money that you loan to the government is being covered by all taxpayers. So in essence, least risk is government bonds. And if you go into corporate type debt instruments, there's a little bit more risk attached to it. Obviously, those corporates, they'll pay their debt or interest from profits. And if you don't make profits and you go out of business, then you just have you probably will lose some of that money. And you can't have, there's a bit of risk attached to that. Grant, just if I can add to that, we're basically talking about fixed bonds. You also get floating rate bonds, floating instruments, and you can call them inflation-linked bonds. You also get corporate instruments that give you a certain amount over interest rates, and if rates move, your income that you get from that moves. So you get variable interest or income type bonds as well. Just to add that to the equation.